The market turned around today, with tech stocks recovering. The S&P was up just over 2%. The Nasdaq had an even better day, up 2.71%. In Canada, stocks were also up, with the S&P TSX Composite up 1.77%. In Europe, the FTSE also performed well, up 1.4%, but in Asia, the Nikkei was down just over 1%. Oil saw a slight recovery today from yesterday's drop, and gold was up on the day. Treasury yields were up on the day, with the Canada 10-year up 3 basis points and the US 10-year up about 2 basis points. In the currency markets, the winners of the day were the Australian dollar and the Canadian dollar. The losers of the day were the Japanese yen and the US dollar. Some good news about the economic recovery coming out of Europe, with some European Central Bank policymakers suggesting that they are more confident in their forecast going forward and that they won't be hit as hard and the recovery will be better. As the ECB had predicted an 8.7% contraction for 2020, that was back in June. One person it says is actually suggesting that they're going to be lowering that estimate and that it probably won't be as bad. So some good news coming out of Europe. It also says that they currently have their quantitative easing program where they've been purchasing a total of 1.35 trillion euros of bonds, that they won't actually have to essentially increase that, and that it might just end with that amount. There's some slight good news coming out of Europe. We'll see how it goes going forward. With all the good news surrounding this economic recovery, I think it's important to keep in consideration that the bad things that might possibly still come. And I think this article makes an interesting point about the bonds market, especially relating to investment grade yields and moving down into below investment grade. So what it says here is that a lot of corporate debt has been skewing towards a lower quality and are at more that triple B negative debt rating, meaning that they could be possibly downgraded below that investment grade. And says if 50% of that were to be downgraded, it could fuel a near doubling of the high yield market. That's pretty significant because that could increase yields in that high yield market, and it also pushes the amount of securities in that market. While it might just seem not that important, it's just a credit rating, maybe the actual metrics and stuff aren't really necessarily changing that much, you might think. But what this does is it means that it doesn't have that investment grade quality, and it means people who can actually purchase those bonds are different, as many pension funds, things like that, have certain requirements that they have to follow. So they may have to, in this essence, only purchase investment grade bonds, especially when you consider a portion of how much they're gonna buy. For example, they may be able to have 30% of their bond portfolio investment grade, and they're only allowed, say, 10% in junk grade. That means that there's a lot more in that junk bond area than there is options in the investment grade, and could possibly become an issue going forward. The Canada housing market continues to heat up, with new home construction at the highest level since September 2017. In total, in August, housing starts reached a level of 262,000 on an annualized basis. That's 6.9% from a month earlier, which was already a pretty high level. That just shows you how hot the housing market is in Canada, which does lead me to a little concern about what's going forward, especially once government stimulus and things like that end and possibly maybe a second wave happens. A lot of this increase comes out of surges in Toronto and Vancouver, which should be no surprise when you consider how much their price increases of units there have increased. A lot of these are also from multi-units like condos. It'll be interesting to watch how the housing market in Toronto and Vancouver develops in the coming year. Some not so good news coming out of Mexico, with inflation above the target. Mexico's consumer prices rose 4.05% in August. That's a year-over-year price increase. It's a pretty sharp increase, especially when you consider a lot of other regions are having very minimal inflation, and this will put an impact on whether or not they can continue to lower the rates. So this will probably impact whether or not they continue to lower rates. As their last 5 meetings, each of them, they have lowered their interest rates half a point, with the current rate being at 4.5%. It'll be interesting to see exactly what they decide to do, considering the inflation, and whether or not the inflation will continue to remain high in that area. Continuing discussion on interest rates, the Bank of Canada had a meeting today and decided not to move their key benchmark overnight rate. It's currently at 0.25%. Some reasons that they said to watch out for going forward is that there might be a turbulent recovery and things might not go as smoothly as people expect, as things in unemployment and areas haven't quite done as well, as there have been some choppy areas that haven't quite recovered as well as they'd expect. Didn't really give too much guidance. I expect that rates will probably continue to stay at this level for the coming years, especially with all the talk of letting inflation run out a bit and possibly reach a little higher. I'm not exactly sure if the Bank of Canada has decided on that initiative. Like the Federal Reserve has talked more about it, but it is suggested by a lot of people in the industry that that's probably the way they're going to go.